Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Welcome to another episode of the Major League Real Estate Podcast. My name is Nathan Sosa, and I'm joined by my co-host, Matt Hamilton. Matt, how's it going? We are close to the tax deadline, so I'm sure everything is just amazing, couldn't be better. Life is just a breeze right now, right?
Oh yeah, no, life could literally not be easier right now. It's always fun. Well, I guess fun is I don't know if that's the right word, but it's always something kind of going into the tax deadline. We were just talking about before we hit record, it's like an issue that comes up last minute, and everything that seems like it should be easy or very simple or straightforward, it just never is. Unfortunately, in this business, nothing can ever just be easy, and
No,
sail away.
It's so strange, right? It doesn't matter how much planning's done, how much communication. Like even the clients we're consistently in communication with and talk with, it just always feel like it always feels like something comes up right at the end, right? And it's like all of a sudden, oh wow, there's this K-1 that hasn't been filed for 4 years, but no one's filed it. So what happens to the reporting of this check, of this entity, of this treatment, this entity, right? How do we deal with that? It's like, oh, someone has a big tax bill. Whoa, hold on, what happened? We've planned out the entire tax year. Why did this appear? And it's like, oh, we didn't think the client, you guys, syndicators, didn't realize you had this coming up, or you forgot it, right? It's like human beings, right? Just in general, it's we're all forgetful, and there's always things that happen, right? And same thing for us as accountants too. We don't there's things that we forget about and don't necessarily remember, and that it happens, right? Human error does exist, but it's just something important to know that once the closer we get to these tax deadlines, the antsier everyone gets, including from syndicators, fund managers to the CPAs too.
Yeah.
Bigger question, in my opinion, is Matt, have you filed your own tax return yet?
I have.
Okay.
I have.
I have not.
I actually got. Oh yeah.
No.
Yeah, I actually got mine filed before April 15th this year. So,
wow. Okay.
Yeah, not to brag or anything.
It's definitely bragging. That's good. It's a good brag. It's a very good humble brag.
Yeah. Humble brag for sure.
Speaking of all of this, right? Why do we care, right? And this is probably going to be one of our less sexy topics that we've talked about on here. Not that tax is necessarily sexy. Our guests are very nice though, and they bring very interesting conversations in here. But what we're going to be talking about today is how can you get your K1s to your investors? How can you get your filings done faster? Essentially, is what going to be today's discussion. How can we do all of this? Right? I know it's everyone's super frustrated. Everyone says, oh, I can't wait for AI to come replace accountants because they're going to just drive out. They're just going to completely replace all this stuff. It's going to be so great and amazing. And it turns out that's actually not the most difficult part, right? It's not necessarily the filings, not just the most difficult part at the end of the day. It's the gathering of the documents. It's then explaining the results of the tax returns. Can AI do that? Sure. If you can create an AI software that's going to gather everyone's documents, get everything in order, and appropriately treat everything in a tax software, amazing. I will send you all the money in the world. I will help you invest into the software. It'll be awesome and amazing for both of us. So back to the overall question. Let's say a syndicator walks in your door and he goes, I want to work with you, but I got to make sure I file my tax return and get all my K1s done by March 15th. What do you need for me to make that happen?
So I think it's important to actually frame this conversation a little bit differently, actually, because one of the things that comes up a lot is that people will come to me and say, especially new clients, people who are new in the syndication space, they're not super sophisticated when it comes to accounting and tax, and they come to me and say, hey, I need all of my K1s out by 3/15. I need to get all of my K1s to my investors. And the way that they kind of think about this in their head is that I issue K1s to my investors the same way I receive 1099s for interest and dividends. This is just the tax form that I give to my investors. And on its face, that's not inaccurate. It is a tax form that you're giving your investors. But what you're asking me to prepare is not the K1s. It's the actual partnership return for the LLC or for the partnership that actually needs to be filed. So when you say I want my K1s by 3/15, what you're really saying is I want my partnership tax return filed by 3/15, which is the same thing, but it sounds different in your head. Because what goes into filing a partnership tax return? Well, you need accurate financial statements. Preferably, you need a trial balance and a general ledger that is complete and accurate to the best of your knowledge. Because what we need to do to actually prepare the return is putting together a balance sheet. We need to put together a P&L. We need to calculate the actual taxable income, whether that's the revenue and expenses, depreciation. We need to know all of the Capex you had. There's so many moving parts, and it's all contingent on you having accurate and complete financials in time to file the return. If you come to me and say, hey, I have accurate and complete financials, but it's March 10th, it's probably not a great situation. We always tell our clients that we want to have those financials for anyone filing by 315. We want those financials by beginning of February. I think this year it was February 2nd, which I think was the first Monday in February. So it's really critical to kind of plan out the timing of that.
No, absolutely. Yeah. It's like realizing they're like, hey guys, we need books to be completed. They need to be accurate. They need to be correct. They need to document. We need to have operating agreements too that are actually finalized, right? That's an important thing as well. So you can't just go, oh, well, we don't have anything finalized. Well, if you don't have these things completed, right? Like, oh, they're halfway done, right? That's good enough, right? No, it's actually not, because now you're not going to have an accurate tax picture. And that means you're going to be missing things. I'm working with a client right now where no one's reported taxable income or losses from an entity for like 3 years because no one's filed anything, right? And so, yeah, but it's important to like clarify this information, because who's responsible for doing the tax return? Who's responsible? Like, who's the tax partners matter, right? They're the partnership representative who's going to be responsible for this. Okay, well, who's following up with that person and making sure it's being done? And the only way we can give a clear, accurate tax picture, and it's important, especially in the first year, partnerships, that's where you get a lot of the right. You get a lot of the losses, depreciation losses that year. It's really important to note that, because it has to be done by three. Like, we want to make sure we have cost segregation study, financials, all of these items in hand and done appropriately, right? And sometimes some quirky things happen, right? It's just doing business, right? Sometimes where you close an entity and then you start another entity, right? All of a sudden you've created 2 tax returns actually, right? So if you do things like that, you don't even realize these steps that make in the process, and that actually creates more complexity. I guess, Matt, if someone goes, okay, wait, so how important is it to get these things done by 315? Is that actually important? Is there, what's wrong? Like, I always see like an extension can cause an audit, right? Is that correct? Or like, well, tell me a little bit about that.
You are asking questions I wish more clients ask. So the short answer is no, your return doesn't actually have to be done by 315. 315 is the tax filing deadline for partnership returns, Form 1065, and S-Corp returns, Form 1120S. For most of our clients, especially most clients in the real estate space, they're filing partnership returns or 1065s. You can file a 6-month extension by 315 and push that filing deadline back to 9/15. And that's an option. And generally speaking, it does not increase audit risk. I will say that for every partnership return I have ever worked on in my career, we have always, across multiple firms, we have always filed an extension for literally every single return, every single year. Even if we file it by 315, we still want to file that extension. And why do we do that? The short answer there is, if you file an extension, what the IRS allows you to do is it allows you to file what's called a superseded return. So let's say we file the return by 315, but we have an extension on file, meaning we have an extended filing deadline until September 15th. Well, what if May comes around, we distribute all the K-1s, and one of your investors says, hey, I noticed there's some sort of error on my return. My distribution on my K-1 doesn't accurately reflect the amount of cash I received last year. And we have that conversation. Turns out the distributions and the GL was wrong, whatever. Now we have to change the return. Well, if we didn't file that extension, we would have to file an amended return, or an AAR, which is an administrative adjustment request, which is not important for the purposes of this discussion, but even more complicated than filing an amended return. But if we file that extension, we have the ability to supersede our previous tax filing, where we just basically file the return again. Here's an updated version. And the IRS accepts it as if that was the first version filed. So it eases the administrative burden for both you and the tax filer if you file those extensions. So long story short, filing an extension for your partnership returns does not increase your audit risk or your audit exposure.
Right. So it doesn't increase audit exposure. Actually, I believe the statistic is over 70% of tax returns are extended. It could be an
Oh,
older
wow.
statistic, but yeah, for most tax returns are on extension. They're not actually filed by April 15th, right? I know a lot of us, like Matt, file by on or before April 15th because like guess what? You know whether you owe, you get your refund, makes a lot of sense. But there's a lot of business returns out there. Now there's way more individual returns, right? But for the most part, most business returns are indeed extended. Why? The reason why is like what Matt mentioned earlier is that sometimes it's hard to wrap up financials just by January 1st, right? Or January 31st, right? The year ends 12/31, right? Not everybody's the best about books and records or accounting. And so then you now have to go, see, let's say you do close books for January 31st, right? Well, then you find out you get it all completed. And now like, oh wait, you got to make corrections. That takes all of February. And now we're like, we're too close to March, right? And so now we're on extension for business returns, right? And so now we're on extension. And then we move into, okay, well, we find out someone changed their address, right? On a K-1 or something like that, right? Matt's smiling because he gets this probably literally on a daily basis, probably after returns have been filed, which is also not ideal.
It's almost exclusively after returns are filed.
Yeah, from Matt's probably getting emails right now saying my address is wrong. And we're on 10/15. It's like that was due a month ago. So sorry, guys. But it's a long and arduous process. And like Matt mentioned, look, we want to have flexibility if we need to change something. So like that way we can file that superseded tax return. And sometimes disaster relief can help with this as well. Just FYI, if that, unfortunately, we have disaster relief all over the place because so many natural disasters, but that can be an option for us to help out. Another thing too is we want to make sure that we can go through the return. And while we want to plan on the front end, there's also an enormous amount of decisions made while looking at the tax return. And things are being filed, things are being done, right? Like, so we're making tons of decisions on the return. Do we take bonus depreciation? Should we do 179 instead? Why, right? Okay, what states need to be filed in or should have been filed in or aren't filed in, right? We have to make all those, right? There's 50 of those, just FYI, plus a lot of other considerations. So there's a lot of things, a lot of decisions and choices we make on the tax return. Hey, should this be presented as other income or should it wind up on a subpage? And so there's a lot of decisions that we need to make there. And the more time we have to make those decisions, the more accurate and more audit defendable positions we can take on these tax returns, right? Not every single decision is like, oh my gosh, we have to defend this or something like that. There's a lot that needs to be considered there. And that just gives us more time and flexibility to do that extension. Real estate syndication tax is confusing to you. Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you will be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed. Now, going back to the start of the question, how can we do that, right? If someone wants it done by March 15th, what do they need to do? What do they need to do to ensure that they can make it happen and that they can work with your team on how to accomplish it?
Honestly, the most important thing you can be doing is just keeping accurate books throughout the entire year. Because to your point, it can be very difficult to actually close your year-end financials within a month once January rolls around, especially if you don't really do much bookkeeping throughout the entire year. If you're trying to clean up your entire year's worth of books in 4 weeks,
mistakes will happen.
Yeah, mistakes will happen. Could be impossible. You're opening up a huge can of worms. And if you have a bookkeeper who's doing your month-to-month financials, they close the books every month. Well, guess what? You get to January and turns out closing, doing your year-end financials, closing the books for that month, you're just closing the books for December. You're not closing the books for the entire year. So, it turns the year-end close into a standard month-end close. So that's the easiest thing you can be doing on a month-to-month basis to just minimize that filing time as much as possible. The other thing is making sure that you're keeping up to date with your investor information as well. If anyone's changing their addresses or, you have a cap table where you're keeping track, accurate records of the distributions everyone's received and updated social security numbers, and maybe if they transferred their entity to a disregarded entity, just keeping track of all the changes in your investor information, that's really important as well. Because, Nathan, to your point, oftentimes what happens is we use the same investor information as last year on their K-1s, and we distribute the K-1s, great. Someone is inevitably going to come out of the woodworks and say, oh, I moved. Why isn't my K-1 updated? Well, no one told me, and maybe you didn't even tell the GP,
Right.
So it just getting that information preemptively is really critical for making the filing process as smooth as possible.
Matt, are you saying that communication is important and not just in like, marriage and like friendships, right? It's also important in business too, potentially.
Yeah, honestly, shut it down there. That's just kind of the golden rule of the central thesis of every podcast, every business, every relationship. It's just communication, over communication. Just communicate as much as possible. It just makes your life so much easier. It doesn't matter what you're talking about. The solution is probably just communicate more.
100%. Totally. What are some ways that like tracking financials throughout the year, right? Other things they can be doing to be more efficient there, work with you on that too. Like from a tax planning perspective, we're like, should they have I'm sure they have a client portal. Should they be consistently sending reminders out to people like, hey, update K-1 addresses, or K-1s are getting ready to go out. We need information if you've moved, if you've had a change of address, if you've transferred ownership to a different LLC or something like that, right? Like, what are some best practices or tips that you suggest there as well?
One thing that works really well actually with an investor portal is giving your CPA, your tax preparer, read-only access to the investor portal. So they can actually just go in and just like download a cap table with all the investor information themselves. If the investors are keeping it up to date there, that can minimize the back and forth of needing to do that. If you are doing substantial improvements, rehab, Capex, things like that, it's important to ask your CPA what information they need about that and what records they're going to be looking at. Because when we go to capitalize improvements on an existing property, we want to make sure that we're maximizing depreciation benefits. And if you're, putting in, LVP flooring, that is 5-year property, making it bonus eligible. Very cool. But if you just put flooring in the description or like without much description, we have to go back and forth and say, all right, you said there's flooring. If it's, wooden floors, that's like affixed to the ground, that is a 27.5-year asset. That is not bonus eligible. But if it's LVP or something that's not, attached to the floor, then that's bonus eligible. So now we've created this scenario where we're kind of going back and forth and gathering more information. So understanding what data points you need to collect and kind of put in your general ledger or anywhere else that you're in the information you're providing, understanding that beforehand really smooths out the tax filing, because every back and forth you can eliminate probably gets you your partnership return done at at least a day earlier, probably closer to like a week earlier. Just like each of those back and forths, they just start to add up over time.
100%, Matt. That's so true. I think it's the most frustrating thing that I think clients find, and look, us as CPAs also find as tax pros, is unfortunately, like we don't enjoy the back and forth either necessarily, right? Like, well, it's not something that like we like thrive in. So, send another email to the XYZ client today, right, to ask these 5 questions, and maybe look, sometimes you miss one of them. And so now we've only got 4 answers, and we got to say, okay, we've got more questions plus the original question that that got missed by accident, right? And so it creates lots of back and forth. So like the more up to date and the more on track and on time communication you have with your tax pro, the more they're informed and know what's going on, it's just going to be so much better, right? That's why having someone that's not just your filer, having someone who's going to be your advisor and planner is super important to do here. It's just really, really, really important to we want to be proactive, right? But we can't be proactive unless you're helping with us, right? And so sometimes it requires us to help be a little bit more proactive, but also it's a two-way street, right? Every relationship's a two-way street. It's like it requires not just us to reach out, how can we be proactive? It also requires you to also reach out to be, hey, what do we need to be proactive about? Right? That's a fine question, in my opinion, to get help for. So all in all, Matt, it sounds like up-to-date books and records, keeping track of investors overall, and then just letting know the quirks, right? The small details you don't really realize. Oh, we set up a second LLC, right? And we have a couple investors that came in through that entity. Or someone wanted to use 1031 funds, but we did this weird thing. Does that work? How does that track here, right? It's like there's so many, like all of that just created 5 tax returns basically, right? And so that's good to know, because hey, guess what? We want to make sure we get those extended properly as well by March 15th. Because guess what? And if you miss that could be a bunch of money, and some of those can't be filed. Some of those have to be filed electronically. Some of them have to be filed externally. Some of them have to be paper filed. We don't have the right web file, or you have to go take it to the website and go file it that way, right? There's so much, right? There's so much under the surface of what goes on. I hope I'm bringing a little bit of light to that today, and Matt is too, but I wish it was a super easy process, guys, but taxes involve the government. And I don't think anyone who's ever been to a DMV understands the government, right? So that's kind of the way I'd say that. Matt, what else, or if anything, that you'd like to add there?
Yeah. No, I think you really hit the nail on the head. It's really just being proactive, being communicative, and really understanding what's needed from you in order to get the deliverables that you're wanting. One other thing that I want to touch on is expectations.
Oh, yes, please.
When you're going to the end of the year, oftentimes clients will come to me and say like, hey, I know we filed our returns, let's say in April or May last year. I really want these returns filed by 3/15 this year. I'll say, great. These are the reasons why we filed after 3/15 this year in order to, change that filing timeline up to 3/15. Those problems are going to need to be solved, and kind of opening up that conversation. But worst case scenario is you in your head say, I want my returns done by 3/15 this year, and then just don't tell me. That's going to create issues, because now you're probably going to go to your investors and say, oh, we're going to get our returns done by 3/15 this year. And then, February 1st rolls around and you come to me and say, hey, I told my investors we're getting the returns done by 3/15 this year. And I'll say, well, that's news to me. So how do we solve this? So expectations there, and expressing what you want is very important, so you can kind of start that conversation. The other thing I want to talk about is expectations with your investors. If you are setting the expectation that they will receive their K-1s by 3/15, it is very important that you are having those proactive conversations with your CPA to make sure that that's happening. Very important. The other thing that I want to talk about is why we even want these returns done by 3/15 in the first place. Because oftentimes I hear from my clients that they want these returns done by 3/15 because their investors don't want to extend their tax returns for various reasons. But what I always like to tell my clients is that when you have investors who are getting into the practice of investing in passive real estate investments where they're receiving a K-1, they should set their expectation such that they will likely have to start extending their tax return. Because in a perfect world, sure, they get their K-1s by 4/15 every time, but we don't live in a perfect world, unfortunately, and things happen. And they're probably at some point eventually going to have to extend their tax return. And they should know what that entails. They should be prepared for what that looks like. And they should be having proactive conversations with their CPA about what extending their tax return looks like for them personally. So I think it's really important to set that expectation for your investors and say, hey, this is our goal. This is what we're shooting for. And I really want you to be able to file your return on time. But unfortunately, I don't control the world. I can't make all of this happen. It's not all on me. So it's important to understand what that might look like. So kind of having that conversation early and setting those appropriate expectations with your investors is really important for managing that investor relationship on the back end when something inevitably goes sideways.
100%. Totally, Matt. I think it's great. Another point, just like another touch point, another piece of communication, right? Yep. Everyone's got to give expectations, including us, right? And saying, hey, unless you tell us that you want this done by 3/15, which a lot of times we place these things in engagement letters for our clients to read and look at, which unfortunately, no one is very good at reading the terms and agreements of anything nowadays. Ours is only 2 pages, not 90 pages like Apple gives, right? So just FYI, it's a little bit shorter. You can probably just skim it and check for key dates. But just FYI, there's important things that we put in there for everybody to read. So those are not just documents or contracts. We don't just send paper for funsies. At least I don't think we do. So Matt, that's great stuff. I know it's not the craziest and most fun and exciting topic, but it's a really, really important one in my opinion, because it doesn't just highlight the reasons why we do things, but also highlights like the relationships that tax pros establish with fund managers and clients as well, and basically how we can work more in tandem together to create a hopefully seamless experience, right? So that's why I want to leave that here today. Guys, thanks so much. If you guys want to reach out to us, if you want to get your tax return filed by March 15th, right? Man, well, we can take a shot at it. Just look in the show notes, click the links below, and you can schedule a call with us. and we would love to chat with you. So thanks again. Then this has been another episode of the Major League Real Estate Podcast.